In finance, there is both bad debt and good debt. Bad debt is owing money on depreciating assets that have fixed payments and go down in value. Good debt is owning an asset by using debt that goes up in value and/or creates positive cash flow above the debt payment and expenses. All debt comes with risk, but some debt pays you to have it while other debt you pay to own. In today's video, we will be showing you smart ways people make money with debt. Without further ado, let's begin. Debt consolidation. Servicing multiple debts is costing you way more than you need to pay in interest and fees. It can often benefit you, for example, to increase your mortgage and use the extra funds to pay off other inefficient bad debt like credit card balances and personal loans. Your home loan repayments may stay the same, but you will use its lower interest rate to pay off higher interest debt, making your savings work harder. Many people like to keep money in a cash savings bank account as emergency funds or a buffer, making them feel more secure. The fact is that this money could be more wisely kept in an offset account linked to your mortgage. You will earn a higher after-tax return and reduce the term of your home loan, all without locking up the funds. Better cash flow management. Managing cash flow is key to minimizing bad debt. The main idea is to reduce interest payments. This can be done by increasing the frequency of payment on mortgage, increasing the amount paid, paying your entire salary into an offset account, or using an interest-free period on a credit card to pay for daily expenses, freeing up other funds for paying off your home loan without paying any interest. Borrowing to create wealth. Once you minimize the bad debt, it's time to start creating some good debt. This is called gearing. Providing you invest wisely and your assets increase in value, gearing helps you create wealth, as the income and capital growth from the investment pays off the debt and exceeds the costs of servicing that debt. Property or shares are often a good strategy here. You can create the extra funds by borrowing against the equity in your home, taking out a margin loan, or investing in a managed share fund. Using lump sums wisely. Occasionally, you may receive a large lump sum of money from bonuses, inheritance, etc. Try to use this to pay off bad debt, or perhaps consider making extra contributions into superannuation. Debt recycling. Debt recycling is where, as you pay off your home loan, you redraw the equity you have built up to invest in shares or other property. Again, the bad debt becomes a good debt that can earn you an income and can be used to pay back the loan, as well as providing tax breaks. Any excess income can also be fed back into your home loan to pay that off quickly and make further interest savings. Invest in a geared managed share fund. A managed share fund is internally geared so that you don't have to take out an investment loan yourself, yet you can still benefit from the gearing effect of borrowing to invest. Here the fund manager borrows, at wholesale rates, on behalf of investors to invest in international or local share markets. With all of the above steps, it's important to get quality advice and to understand the risks and the potential returns. Leverage in real estate. Buying real estate allows you to leverage your capital by multiples of 20 with 5% down payments or multiples of 1,000 with monthly payments. For a down payment of $10,000, a real estate investor can own a $200,000 house with a $2,000 monthly payment. Real estate investors make returns on the full amount of the loan, not just the money put into the investment. If the piece of real estate goes up 20% in value from $200,000 to $240,000, then the $10,000 down payment creates a 300% return with the $40,000 investment return. Debt can also be used to buy monthly rental properties or houses to be used as an ARM to create cash-flowing assets for monthly income through leverage. The returns in cash flow is on the total debt, not the money invested in the property creating great returns. Leveraged buyout. A leveraged buyout happens when the buyer or buyers of a company takes on a large amount of debt as part of the purchase process. The buyer will use assets from the purchased company as collateral to acquire the company, with plans to pay off the debt later after the buyout using future cash flow from the company. After a leveraged buyout, the buyer ends up with controlling interest in the target company. Short selling. Selling short reverses the normal order of buying and then selling stocks. Selling short means to sell something you don't own. When you sell a stock short, you borrow the stock from your broker and sell it to a buyer. You then owe the broker the shares. You receive cash from the sale, but have to use it to buy the shares later to pay back your broker for the loan of shares. You are long cash and short the shares on a short side trade. You're in debt for shares using the credit available in your margin account. When you buy to cover the short position, that will be your debit purchase price to buy back the shares you were short in the open market. Then your broker can return the shares to the account they were borrowed from. Margin account. A margin account is a type of brokerage account where the stockbroker lends the investor cash or shares, using their account as collateral to purchase securities. Margin trading is when your broker adds buying power to your account to increase the size you can trade and the quantity of trades you can make. Margin can be used to add leverage to your trades or for faster turnover on your trades without having to wait for them to clear after entering and exiting. If margin is used to increase the size of your trades, then your results are amplified. If you trade twice the size of the position you would have traded without margin, then your wins are twice as big. But also, if it's a losing trade, it would be twice as big of a loss. Margin accounts allow investors and traders to generally double the size of their total trade position sizing if the stocks they buy are able to be used for full margin. Margin, more importantly, allows day traders to maintain buying power without needing to wait for all their trades to clear. Using debt for living expenses. Investors can pay living expenses using debt to avoid income tax and taxable events like selling assets for capital gains. For example, they can use a margin loan on their portfolio holdings with their broker without needing to sell any of their stocks at the moment, and then pay it back later by selling stocks that are down, creating no capital gains tax. High net worth individuals can also live off lines of credits backed by their assets and only pay off their loans from sources with optimal taxing structures, like the sale of a personal residence that are not taxable in most states, selling losing investments, dividends with a lower tax rate than income, margin loans, or capital gains from stocks that have a lower tax rate than a high income tax bracket. So guys, let me know your thoughts down in the comment section below. For more interesting content, give this video a thumbs up and don't forget to subscribe to the channel for more awesome content. Have a nice day, and I will see you in the next video.